Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. As market narratives shift almost daily for traders and investors, a hard look at the underpinnings of what continues to power a lift in equities is warranted here. Our next guest says we are in the throes of the second scare of the tariff worries for 2025. However, it may be just that, a scare, even a blip perhaps. Corporate tax cuts from the so-called One Big Beautiful Bill may provide sustainable tailwinds to markets that they've been missing during the messy tariff policy rollout. Joining us here today is Director of Quantitative Market Strategy at Fidelity, Denise Chisholm. Welcome, Denise. Love your research this week, as always. How are you?
Thank you. I'm good. How are you? Although it is very rainy in Boston, so I'm still wet from the morning commute.
Oh, no. And that sort of lingers with you the whole day. I'm really sorry to hear that. It's not good at all. So tell us a little bit where we begin with looking at the pieces of the Big Beautiful Bill. It's a tax bill. It's a discussion on taxes. Much has been made of the debt that will not get smaller. What are you zeroing in on?
Yeah, it's interesting. There's a lot of talk about the debt not getting smaller, and there's certainly a lot of talk about the consumption side, maybe not as many tax cuts as people were hoping for, but I don't see a lot of people talking about the corporate side, and I think that's the most significant part to the market. So as much as there's no touching the statutory rate for corporate taxes like it went down in 2016, there is a big cut in what will likely be the effective rate because of 100% bonus depreciation and R&D expensing that's going to be retroactive to the beginning of the year. Remember, this was all in the original 2016 bill that was then being phased out. This time, all of that bonus depreciation and expensing is permanent. And this is very significant. You know, in some ways, when you sort of do the math from an effective perspective, it's as much as a 7% cut in the effective rate. And that's very significant in terms of what corporate profits might be over the course of the next year.
So if you get X company making whatever it is in free cash flow, they've suddenly now got 7% more? Is that what we're...
Roughly 7% more. I think that's right. I mean, I think it varies per industry and certainly for each sector, but there are some technology companies that's almost a direct throughput. I mean, the more you spend in terms of CapEx, the more diluted it might be. But I think that I think that the math will be between 3 and 5% more free cash flow growth than maybe you were thinking coming into this year. And again, when you study this historically, I mean, it's interesting because we always talk about these strange signals, right? What you often think you know just ain't so in the data. This is one of those situations historically in the data where it actually aligns with what you would think, meaning corporate tax cuts must be good for markets, right? And it, in fact, is the case. So, you can either research the effective tax rate ex recessions, or you can look at the statutory tax rate. And what you see from those bulk of instances we have since the 60s is that not only does it usually provide the spark of an earnings recovery and a GDP recovery and a confidence recovery, but it's usually a durable spark. So you usually get in the year it's enacted, you don't just get more earnings growth, you also get multiple appreciation on top of it. And I think that that's the most interesting part because the market does what usually it does, which is to look through and say, most of the time that this is the beginning of something that becomes more durable and I'm going to price it in ahead of the time. So that is how...
No, please go ahead.
Yes, that's how you get this double tailwind of markets where even though the starting point is still expensive, you are likely to see, because of this bill, multiple appreciation and higher earnings growth than you would expect.
Fascinating. Okay, I want to come back to the expensive markets because that fits into so many things. This policy, as you say, is durable. It's permanent. What is being discussed and has been enacted. It's a stimulus of sorts. A lot of stimulus programs or policies will come through and then they'll fade off after. It's just to kind of get you through X or whatever. And it either has to be renewed or whatever it is. Again, just to reiterate what you're saying, something's permanent, which means it just doesn't have to have a cliff, basically.
Right, that's exactly right. So the markets have more clarity on the sustainability of that, right? And in some ways, we're all talking about the uncertainty in terms of tariffs and the
Yeah.
economy and the Fed. Well, here's something that's actually pretty certain now. I think corporate America knows what the rules are in terms of tax certainty. So this is, a significant offset. Now you're not seeing that in the consumer tax cuts. Many of them are temporary, rolling off in 20, I think it's 2030, which is so some of it you see that fiscal cliff, but you're not seeing that on the corporate side. And I think that that's important to recognize.
Also, when you said historically, taking a look at this, in a non-recessionary situation, we've actually been waiting for a recession for quite a long time, it seems, which has not materialized, which you've commented on in the past. Something that is, we've missed the recession for now, and you get something like this on top of it. I guess just talk about the dynamics historically of how that could work out for equities.
Yeah, it's an interesting dynamic in the sense that we're all still struggling with what will tariffs mean to the US consumer? Will corporate America spend and hire more people since jobs have been quite lackluster? Again, I think that we can all struggle with what the future might hold, but you always have to juxtapose it with what the market has already discounted. And that's the part of the narrative that we need to discuss more. Remember, at that low, which was, I call it the bear adjacent market, down 20%, that is basically akin to discounting a 15% earnings correction. That is a recessionary earnings correction. Right? If you think about going backwards to the start of the year, we were growing profits, or we thought we were going to grow profits between 7 and 10%. And on the tariff sort of scare or liberation day, all of a sudden earnings revisions came down to bottom decile levels, and earnings growth came down to, let's call it, 4 to 5%. Well, now insert the Big Beautiful Bill Act. Again, that math is a 7% drop in the effective rate. So that is obviously a stimulus to future earnings growth.
Mm-hmm.
What if now, instead of that 15% contraction and even that 4 to 5% earnings growth we discounted over the course of the entirety of the next year, maybe it does look more like 10 to 15%. It's not just that earnings are growing 10 to 15%. It's that juxtaposed with what the market had already thought at that low. So yes, I know we bounced back a lot. So a lot of people say, well, isn't that already priced in? I would say two things from that. First is that don't be very short term in terms of market action, thinking about what it discounts. Because when you look back over the last 6 months, average returns over any 6 month period for the S&P 500 are, let's call it 4 to 5% from a total return perspective. Ours have been roughly flat. So from a longer term perspective, you still have that ability to have a statistical catch up trade. And what you see historically is, again, the more a ball is in motion, it tends to stay in motion, meaning that the market is telling you that there's more here to follow. We had this kind of rebound, and I think it was coming into 2024 as well, where the market was up every week for 15 weeks by an average of 15%. And everybody was like, well, that's got to be too far too fast. And when you back test it, it's perfectly predictive of a more advancing market. Why? Not because it's too far too fast. There's more statistical evidence to say, oh, the market went down too much relative to where we are and needs to catch up. And I think that's the framework that might help investors understand why we've seen such a strong snapback and why we still might see a more durable rally from here.
So based on what you just said there, there's potentially more to go, which makes you think that perhaps the bounce back and therefore the valuations are not too expensive. But at the same time, when you have a corporate tax rate that comes in when stocks are kind of expensive, I think there's a perception that stocks have come right back up to, certain stocks have come right back up to their valuations prior to that 20% sell-off. So they are kind of back an expensive all-time high. Should a corporate tax rate work when things are already so high? I mean, what do we do with that?
Interesting. It has historically, and that's the irony of equity markets, is that you end up with the high valuation or high multiples as almost like an alpha factor, meaning that the higher multiples are, the more you go up over the course of the next 12 to 18 months. And I think what that shows you is that the market is correctly pricing in what will be to come. Remember, the market's a discounting mechanism. So as much as stocks follow earnings, if the earnings become visible and durable, the market's going to price that in earlier. So remember, I mean, as much as we want to say multiples are predictive, it's almost more, I would say, almost philosophical from a multiple being predictive, because really the way you would like to price the S&P 500 is on, let's call it core or mid-cycle earnings. We don't know what those are. It's kind of like the Fed with R star. We're all sort of guessing on what those mid-cycle earnings are going to be. But what if mid-cycle earnings are in fact higher than you think, right? This earnings growth is more durable. So when we look back, the multiple right now is actually more expensive than you thought. So therefore, you had actually a statistical double tailwind of higher earnings growth and multiple expansion, because as much as you were pricing in some of it now, you weren't pricing in all of it to mid-cycle earnings. So, and that's why you end up with this situation where if I look over any 1 year time horizon, every quartile of multiples from cheap to expensive carries the exact same odds of a market advance, which tells you that, look, there's something that we don't know about what that multiple is. And I think that there's a lot of nuance behind valuation. And that's why you can end up in these very weird situations where, it's not really the headwind that you would think. It's just the market telling you that, aha, earnings might be stronger than you think.
So, I mean, you don't want to overthink this too much, but I mean, was this planned? I mean, it was planned because this is what the Trump administration, came into power on, this sort of three-legged stool, the corporate tax story, the deregulation, and also tariffs. We've been in the haze of tariffs. And as you say, and I think we said at the beginning, this, your words, could be the second worry of tariffs or the second scare. But it's a lot of haze, and what you're talking about is actually incredibly pointed and has some very interesting, specific things that it can do for companies. I guess I'm just wondering, is the haze starting to move aside, and are we looking at like the real pieces of these three-legged stool policy that was supposed to be enacted?
It might. I mean, they certainly came in, let's give the administration the benefit of the doubt. In some ways, some of their chief talkers in the market it was really a three-pronged strategy with deregulation, tax reform, and in some ways, trade reform to set up America as a place where we can produce more goods and in some ways services. To make the future much more viable from a deficit perspective, from a growth perspective, and from a balance perspective. So to the extent that this, you asked if this is a cohesive strategy, I do think it is. I think there's a lot of back and forth with it. I mean, maybe we look back in 10 years and say, oh, it looked like a cohesive strategy, even though it didn't feel like it at the time. And I think to your point, there is going to be back and forth in terms of tariffs. There's not going to be a back and forth in terms of the reconciliation bill, since that's already passed. But what does it mean for this second wave of tariff fears to be impacted in the market? We can study second waves through time, and I think that that's the interesting part. I remember even talking about it during the pandemic in terms of the second round of COVID. What does it mean relative to the first round of COVID, the first wave of COVID? And you can study history, and we saw this back in the 80s. The bond vigilantes. What did it mean for the second surge of inflation? And what you find is because the market impact was so discounted so abruptly the first time, the second time is absorbed much more easily. And if you think structurally in terms of what tariffs have meant over the last 3 months, it hasn't been as influential as many investors thought, meaning that it didn't have an immediate impact. So yes, there was a lot of pull forward demand. Yes, we still might see some price increases. But again, remember, the more you drag all of that out, the more income grows over time, the less of a shock that will be to the system. And in some ways, even from an inflation perspective, the longer it takes for tariffs to translate into inflation has been decelerating, baseline inflation. And in some ways, goods is still in deflation. And we're seeing that from exports out of China, still in deflation. Right. So, you end up with this situation where, yes, there will be price increases, but now, because it's so much further in the future, off of what level? So I think in some ways, like when you think about what the tariffs mean to the market, that second wave, a lot is already diluted because much was discounted in the first wave. And two, what we've learned from the first wave is it might take longer to actually filter through into the economic data than we think, which is much less of an impact to the market overall.
So when you take a look at how this might position the United States in terms of vis-a-vis, so we talk a lot about the fiscal impulse, the fiscal dominance, and of course the debt, which has had more debt added to it through the big beautiful bill. We kind of know that conversation. At the same time, the rest of the world is ramping up debt to often pay for defense. You look to Europe, they're spending more. They're going to spend more. They're turning on their own taps for their own reasons around the world. Does that, on a relative basis, make U.S. debt less of a talking point, less of a central talking point? I'm just kind of curious where that one evens out and others tick up.
I think that that's likely when we go forward. I mean, we've talked a lot about how it is in some ways the best house in a bad neighborhood type of issue as it relates to currencies. Because again, it's, to the extent that you sell dollar, you can only buy so much gold. I'm not sure how much Bitcoin you want to buy. You have to find another currency. And if the other currencies like Japan or the euro are sort of saddled with either debt that's growing or current debt that are issues, or even, as we talk about sort of what tariffs might mean, deflation. I mean, debt deflation is much worse than an inflationary debt issue. So I think that those are bigger risks when you look overseas. So yes, I think that you're exactly on point where the relative debt gain might be more supportive of the dollar going forward than many investors expect.
That's so interesting. And in terms of the corporate tax policy that's just come into effect, do you think other countries will be on the back foot trying to reform their own corporate tax to either compete with that or for their own reasons to try and stimulate their own domestic? I mean, can others catch up now that this has been put into place in the United States?
I think from a growth perspective, I consider this bill pretty pro-growth. So I think it makes it tougher to catch up to the US from a growth perspective. I mean, we've obviously seen over the last really decade, US GDP growth accelerate when the rest of the world has been more stagnant for the most part. And I think bills like this that I would call pro-growth in terms of capital spending, in terms of profitability, it means, again, maybe, the more profitable corporations are, the more likely they are to hire, the more likely hiring you see, the more likely the economy is to grow. So when you see bills like that, I think that it makes it tougher to catch up to what we used to call, sort of US exceptionalism. And it's not clear to me that we won't again look back and say, well, it was just a pause in terms of US exceptionalism over the course of the first 3 months of 2025. But in fact, that was a trend that was much stickier into an entire decade than we expected.
What will the revenues from tariffs, as they are now, because we don't actually know what they're going to be in a few weeks from now, are they being well received in terms of paying down the deficit?
Yes, I'll take an optimistic stab at the math behind that. Obviously, the deficit projections, there is no tariff revenue in there in terms of the offset, since it's not part of the legislative package. I mean, we'll see what that means going forward with all that's in the courts. But in some ways, what it could look like is between 250 and 350 billion dollars annually over the course of the next decade, which might offset what is expected to be added to the deficit. Again, these are all estimates, so we don't actually know what will happen. I mean, the worst thing you can have from a deficit perspective is a recession. At least that's what's been true in history. That's what really adds to your deficit, which certainly we saw that in 2020. But you do have an offset that I would say very few people are talking about. And what I've seen people write about in terms of tariffs, and I understand the incentive, is that, well, if you tax imports, then we will have less imports going forward and we will have more US production with potentially higher prices. So that 250 to 350 billion dollars of revenue each year is likely shrinking.
Right.
What if it actually doesn't, create a headwind for imports, and imports still grow both on a nominal basis because inflation is higher and because it regains share over time, meaning that even if the government put in an appropriate incentive for us to save as opposed to spend, it actually didn't work. What if that 250 to 350 billion ends up more like 400 billion to 450 billion over the course of the next 10 years, even more offsetting what we thought was going to be the addition to the deficit. So I don't hear anybody talking about the fact that there is at least an option or a viable path that we do actually have viable deficit reduction as a percentage of GDP over the next 5 years.
In terms of sectors, where is the winners? Does it still sit with technology, or I mean, is there something else that could be creeping up? We're talking about a lot of different moving parts to rejig an economy. Some of it has to do with AI and data centers. We know that. Who wins here?
I still think it's technology. Still think technology and sort of the technology options within the communication services sector are the best risk reward in the market. And it's partly on that secular tailwind. I mean, in some ways, they are one of the beneficiaries from the one big beautiful bill in terms of free cash flow growth. But remember, our starting point for technology is now with this valuation reset. They were already in the bottom half of the distribution on price to free cash flow relative to the rest of the market. You put that on top of the fact that not only does growth not have to come down, but it might actually look too low over the course of the next year. You have a really strong risk reward. And again, it's back to that. I think it's going to be tough for the rest of the world to keep up with how much technology can grow earnings over the course of the next, let's call it 12 to 18 months. Plus, with the fact that I still think you get multiple appreciation because you've had such a strong reset. To me, it almost looks like more durable and sustainable leadership than any time over the last 3 years. Again, this is to me. So, in some ways, I thought technology was, look, I think it was a decent risk reward, but I thought there were better sectors in financials and in consumer discretionary. But now I think that technology is actually the best risk reward in the market. And when I look at financials, there's still options within financials, and that's my close number two. But in some ways, technology looks like financials looked to me 18 months ago, in that there's been enough of a valuation reset where you start to care less about, do I need to get the fundamentals right or wrong? And that's why semiconductors here look so interesting to me, because yes, there's probably going to be a lot of bad news. There's certainly a lot of uncertainty, but a lot of that on my numbers is pretty priced in. When you're at the 40th percentile in terms of relative valuation versus the rest of the market, then you have that ability to price in bad news in advance. So again, these look like viable long-term risk rewards where I think it looks like US leadership.
Denise, what are the biggest headwinds to strong market performance for the rest of this year? I mean, already you're kind of providing the other side, but what do you think?
It's always tough. So people always ask me, Denise, what do you see that's going wrong? What are the biggest risks you're monitoring? Look, I think other people might have better answers than me. I try not to see the future and focus on what that market is discounting. And I do that because I think that you can get so lopsided as an investor trying to focus on what risk should I analyze when you think whatever risk comes to light is going to have a systematic impact on the market. And more often than not, you're just wrong in terms of the systematic impact on the market. You might get the risk right, but then you get the market action wrong. Let's take the dollar as an example. So let's just say the secular decline in the dollar is actually right, and the dollar actually, continues to depreciate by 10% over the next 6 months. Some people will call that a big risk in the market. When I look at the data, that actually looks to be bullish for both GDP growth, corporate profit growth, and the market itself. So when you study history, all of those things that you think might go bump in the night aren't really as systematic as you might think. Again, I always go back to this example of, when do you think was the market low between 1976 and 1985, when the recessions were in 1980 and 1982? Most people pick 1982 because that was the second of the back-to-back recessions, and it was an 18-month recession, which was the longest and deepest since the 30s. In fact, the low in the market was 1978, when Volcker came in and said, I'm going to put us in recession to quell inflation. So that low in 1982 was higher than the low in 1980, which was higher than the low in 1978, which is why I don't love, though, what goes bump in the night. What risk do you see on the time horizon? Because can you imagine a situation where in 1978 you'd say, yeah, the things that I think we should be looking out for are two back-to-back recessions, and one the longest and deepest since the Great Depression. Nobody would invest in equities, but in fact, that's exactly what you wanted to be and sort of ride through the volatility. So that's a long-winded way of saying, I don't know what could go wrong, and I try and focus on what the market is discounting to sort of look at the risk reward.
And to see what could be going right. I mean, it's incredible. Right. Many countries, of course, have not made tariff deals or final tariff deals with the US yet. How seriously Are they taking sort of the tariff threats, other countries around the world? I guess, yeah, a question of how powering through perhaps other countries are trying to do right now.
Yeah, don't know how seriously anybody's taking anything. We'll see that over time. I think that I try and study the market impact from a US perspective.
Yeah.
It's from, an ex-US perspective. These are growth shocks. These are deflationary growth shocks or recessionary shocks. I mean, to the US, it's a potential stagflation impact. I mean, we'll see. My base case is that it doesn't turn into an inflationary event. But I think it's interesting because, most people, we've seen the rotation into outside the US, but to the extent that the tariff threats become a viable solution going forward, I actually think that a fair amount is not priced in ex-US markets in terms of what that growth shock might look
That's
like and
interesting.
in terms of what that deflationary risk might look. Again, back to the math of tariffs and what it might mean to the US. If we say it settles around 15 to 20% of imports, that's about a $250 billion hit to the consumer that's now fully offset with lower energy prices and a little bit of a tailwind from the tax bill, and $250 billion to corporate profits, which again is completely more than offset by the beautiful big beautiful bill that we've just seen in terms of the cut in the effective tax rate. So it's not clear to me that really from a net perspective that the US is going to be faced with that problematic of a structure, which is not to say that we won't see tariffs in the headlines and not to say that we won't see this idiosyncratic risk as it relates to copper, as it relates to lumber, as it relates to pharmaceuticals, as the Section 282 or as a 232 or whatever those section specific tariffs will sort of roll on. But it is to say that, again, studying history, it might be less of a systematic impact on the US than you think, or less of a systemic impact than you think.
That is so fascinating. Okay, before I ask you to close out with bottom three sectors, one of the things that some people think could go bump in the night is replacing the Fed chair earlier than sort of the expected time. What do you think about that? That is a risk. We're asking to go down that road, but is there anything again that you need to sort of think about in terms of the interest rate policy that would fit into what we're talking about today?
Yeah, it's not clear that interest rates are the critical driver of the market. If I thought that
Right.
interest rates from a real perspective in terms of the 10-year were high enough to cause damage, then I think maybe that cuts one way or the other. We can argue and debate about whether or not we think the Fed's making a mistake right now. But when you look at real rates relative to history, it's not that big of a mistake. And it's not clear to me that interest rate cuts on the overall economy would be that either bullish or, in some ways, if they had to cut a lot, might skew in terms of from the growth perspective. So I do think that that's still a sideshow in the market. Again, you can debate things like that are philosophical, like Fed independence and what a shadow Fed chair might mean. But with interest rates where they are, which is not high enough to, really cause a problem for growth, and not in a way that is a problem for the overall economy, it's not really clear to me that that would be market moving. Remember, interest rate cuts are always significant as it relates to the why. If the Fed's cutting because they have to cut, that's a problem for markets. If the Fed's cutting because they can cut, that's usually bullish for markets. But usually bullish for market, the market also has other tailwinds. It's not clear to me that we need the Fed to cut.
That's a good place to be.
Right.
I mean,
That's right.
there's nothing wrong with that. Okay,
It
let's
doesn't
go.
feel like it, but yeah.
Yeah, it doesn't feel like it's true. Sentiment's still a bit wonky. Tell us a little bit. Okay, so top three, bottom three sectors. You mentioned tech and financials. What else?
Yes, tech financial still consumer discretionary, even though it has not worked. I still think that the valuation setup is still a positive risk reward, both on an equal weighted basis and on a cap weighted basis. So the top three from a rank order perspective is tech, but then also financials and consumer discretionary as options. And then the bottom three will still be energy, despite the fact that maybe shales actually are rolling in terms of production. I think that they need to. We need to take excess supply out of the market because obviously prices fell too far too fast. So energy still, consumer staples without a doubt, and utilities. So again, those defensive sectors, I still think have a really negative risk reward. And the economically sensitive sectors like technology and financials and consumer discretionary still look like the place to be on my work over the course of the next 12 to 18 months.
Fantastic. Denise Chisholm, what a completely different perspective you have brought. We're always so grateful for that. Thank you for joining us.
Always great to be here.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.